Welcome to Home Biz Tax Talk. My name is Lysandra Everett. I am the Home Biz Tax Lady. Home Biz Tax Talk airs Monday through Friday, 9 o'clock-ish. And when you tune into my show, you're going to be hearing about topics that are important to the home business community. All right, today I'm talking about taking out a loan to pay off tax debt. So I really wanted to really lay out the big picture of all this so we can really have an informed decision. So just to let you know, the answer is not the same for everybody. It's not a definite yes and it's not a definite no, but I'm going to tell you what you need to consider before you make that decision, okay? So first of all, the IRS just announced that the interest rates aren't changing. So usually for your tax debt, the interest rate is your the federal short-term rate plus 3%. So right now it's staying at 5%. And so what does that mean? All right. So let's talk about the penalties and what the interest charge is, and then we'll go from there. So you've got two main penalties: a failure to file penalty and a failure to pay penalty. The failure to file penalty is usually the most expensive. It's 5% of the unpaid taxes for each month, and but not to exceed 25% of your unpaid taxes. And the penalty starts to accrue the day after the due date. So, and if your return is more than 60 days late, your penalty is the lesser of $210 or 100% of the tax owed. So if your taxes is less than the $210, then you would pay double that. So if you owe $100, then you would pay $200 for a failure to file penalty. Okay. So, the failure to pay penalty is 0.5% for each month. Okay. That it's late, and there's no maximum. Okay. Half percent per month. And if you have them both, then the maximum amount charged for the two penalties is 5% per month. Okay, now let's look at how this stuff is compounded, okay? Because this is really what makes a difference. We're going to be looking at how the interest is compounded and how payments are applied, because it does make a difference. Okay, so when you're looking at the IRS, okay, your interest is compounding and being added daily. So they look at your daily balance every day, however much you owe. They figure out how much interest you owe and they add it. Then the next day they do the same thing. So every day your bill is getting larger and larger, even if it's by just a few cents. Have you seen that? You remember when you were little? You did that whole penny compounding thing. You get paid a penny today, and then tomorrow it doubles, and then tomorrow it doubles, and then tomorrow it doubles. Okay, this is kind of the same thing with the interest. Every day they're looking at how much you owe, and which is, yesterday's interest is going to be included in how much you owe today. And then they're going to figure out how much you owe. And then tomorrow, the interest that you owe today and yesterday is going to be added. Okay, so I want you to get that. Now, when the IRS applies their payments, they apply your payments to the tax due first, any penalties, and then the interest. All right. Now, when you're looking at a loan, okay, the loans can be a little bit different. Now, your loan rates, this is why you need to know the terms of your loan, because it can be different with the way that the interest is compounded. So most loans, personal loans, the interest is compounded and added monthly. So they look at what you owe at the end of a month and then base your interest off of that. Okay. And usually when you take out a loan, you take you take out a loan for your mortgage, right? You got 30 years and they basically map out between month number 1 and your last payment, how much you're going to pay, how much, interest is going to be accrued and all of that, right? And so when you pay a loan payment though, then if they apply your payments to late fees first, interest, and then principal. Okay, so there's a difference in how the payments are applied. So that's why I say it's really not a cut and dry answer for everyone. It's going to be based on the amount that you owe, what kind of what kind of interest rate can you get. If you're going to get some 26% loan like on a credit card, dude, then you might as well just deal with the IRS and keep it pushing. Okay, but if you got a favorable interest rate to pay off your loan, like most home equity loans have a pretty decent interest rate. I am not telling you to go take out a home equity loan to pay off your taxes, okay? I am just giving you an example. Let us make that clear, all right? But what you want to do is, is look at the big picture and like how much interest and penalties are you really going to be paying? This is why I tell you that even if you have a tax liability that you can't pay, that you go ahead and file your taxes anyway, because at least you will not have that failure to file penalty, which is 5% per month, up to 25% of what you owe. So when you're talking about, and especially for my home business owners, baby, if you are living off of your business, you are not, withholding taxes. Okay. This is not a job. All right. So this is why you have to withhold this 30%, because if you don't, and then you wind up with a $30,000 tax bill. Okay. Let's do the math on that. 30,000, because, that is real easy to do. Can I tell you that? Times 0.25. Okay, so if you got a $30,000 tax bill, you can pay up to an additional $7,500 for a failure to file penalty because you didn't file your taxes. And that's why I also explained to you that when you have a tax debt, that you stay in contact with the IRS. They are not going to put you in prison for not being able to pay your taxes. They'll put you in prison for not filing your taxes, but not for not being able to pay your taxes. They're gonna work with you. So you definitely want to file even if you can't pay the tax debt, okay? Because they'll work something out, all right? The IRS has 10 years to collect a tax debt. Now, that does not take into account your state, okay? I will also tell you that you take care of state first, then federal, because the state is like a freaking piranha, okay? States are like piranhas compared to the feds, all right? So like I said, so to make that decision as to whether or not, to get a loan or whatever, again, it's really something that you have to do the math on, looking at the interest rate, looking at how much, you're going to be paying over time, and, and then making that decision. So, so yeah, it's unfortunately, it's not a cut and dried answer. I can't say, because it might be right for one person and not right for another person. But the main thing is that you definitely want to file on time. Send whatever you can, because it's based on how much you owe. So if you got $1,000 tax bill and all you can send is $100 right now, send the $100, because that's $100 less of interest and penalties that's going to be accruing on your bill. All right. And if it's at the point where you might owe this money, but you don't have the money to pay, again, you got to work with the IRS, because by doing that, you'll stay in right standing. And there's a whole process, to talk about offers in compromise and all of that stuff. That's a whole nother broadcast. But the main thing is that, just to say, okay, should I take out a loan? Definite maybe. But it's definitely something to be looked at, because when you think about, like I said, a $30,000 bill that, is going to be accruing interest and penalties over time versus a $30,000 loan, which may be something more favorable to you. So, so it's not a cut and dried answer. So, what's the takeaways? The takeaways is, number one, file on time. Okay. File on time. And especially for my people that filed an extension. Okay. So the extension deadline is October 15th. That's it. Anything after October 15th. Now, if you don't file by October 15th, okay, the tax due is going to start from April. It's not going to start from October. So when they're assessing penalties and all of that stuff, it's from April. So if you did not file an extension, then you are already got the failure to file penalty happening right now. If you did not file in April and you did not file for an extension, you got the failure to file penalty happening right now. If you are getting a refund, ignore everything I'm saying. When you're getting a refund, you don't have to file for an extension, but it's always a good idea to do so, because in the event that you're expecting a refund and you wind up owing, then you don't want to get that additional penalty. Okay. So I hope that makes sense. You don't have to, but it's a smart idea too. And in the refund situation, you've got up to 3 years to claim your refund, or the government, the Treasury will keep your money and thank you for it. They won't even send you a thank you letter. They just gonna keep your money and just not tell you that they were supposed to give it to you. Now, in the case of refunds, here's something else. Now, if the IRS owes you money, okay, you would think that they would have to pay you the 5% interest, right? No, the IRS has up to 45 days to get you your money. Let's say something happens and they don't. If they miss their 45 days, let's say it's 60 days, they do have to pay you interest, but the interest is taxable. So just to throw that in there. So yeah, like, we're going to pay you some interest because we kept your money too long, but you owe us taxes on the interest that we had to pay you. So you'll just be giving that money right back. Just an extra tidbit, thought you should know. But that's really it, you guys. There's, dealing with tax debt can be a difficult thing. And like I said, the worst thing you can do is to ignore the IRS, to not talk to them at all, because at the end, if you don't communicate with the IRS, then you put them in the position to where they have to enforce the law. That's when you look at the garnishments. That's when you look at, tax liens and seizing property and all of that. That's because you have not responded. As long as you're responding to the IRS, you're responding to their notices, or you hire someone to help you, then you're in better standing with the IRS, and, you don't have to worry about losing everything. That's, again, you see the darn commercials on TV that drive me absolutely bananas. We owe $10,000 and, these people negotiate us down to $200, and you see them sitting in this nice house and all of that stuff. Honey, that is TV. Okay. Because you're not going to be sitting up in this really nice house with all this equity in it, and you owe the IRS. That ain't going to happen. You're not going to be having a retirement account with, all of this money sitting there, and you have a tax debt. That's not how the IRS gets down. They're looking at all of your assets. They're looking at, what kind of retirement savings you have. If you've got a house, if you've got a car, they're looking at any type of investment. And they just recently added cryptocurrency. Okay. So you have to disclose over a certain amount. You've got to disclose all these assets. So it's not like you're going to get to hide your money and the IRS not come for you, because if you lie on those forms about the assets that you hold, that is a felony. And for that, you'll go to prison for sure. Okay. So listen, I have gone on long enough. I really hope this helps you out and just give you some food for thought when it comes down to dealing with tax debt. If you have tax debt, I forgot to put my little thingy up here. Reach out to me. You can book a call at www.homebiztaxchat.com. And that's it for today's episode, you guys. Thank you so much for watching. We are here Monday through Friday, 9:00-ish, and you can come here to get your questions answered about your home business taxes. All right. Have a great day, and I'll see y'all next time. Bye.